Hello and welcome to session 38 of Direct Tax 2, 4th semester BCom of Mangalore University. Now in this particular session, we are going to learn about the computation of short-term capital gain and long-term capital gain under section 111A and section 12A. Now what is this section 111A associated with and what is this section 112 connected with? So let's understand this. 111A is to do with the tax on short-term capital gain on transfer of equity shares of a company or units of an equity-oriented fund, that is oriented mutual fund. Now, what are the rules? If an SSC has short-term capital gain arising from the transfer of equity shares of the company or units of an equity-oriented mutual fund, which were acquired on or after 1st October 2004, then such capital gain are taxable at 15% as per section 111A, provided such a transaction is chargeable to securities transaction tax, that is STT. So in simple, any listed equity shares or equity-oriented funds, if it is transferred, any gain arising on such transfer of equity shares or equity-oriented mutual fund is taxable at 15%, that is under section 111A, provided STT has been paid on such transaction. If securities transaction tax is not paid on the sale, then tax rate would not be 15%, rather it will go to the general slab rates. Then short-term capital gain would be treated just like the other income and it would be shown under the regular slab rates applicable for an individual or partnership firm as the case may be. Then we have tax on long-term capital gain on transfer of equity shares in a company or units of an equity-oriented fund. Now this is covered under section 112A. If an SSC has long-term capital gain arising from the transfer of equity shares of the company or units of an equity-oriented mutual fund, which were acquired before 31st January 18 and sold before 1st April 18, that is that window of 2 months, that is February 18 and March 18, because we are talking about the last day of the month of January, 31st January 18 and first day of April. So we have only that 2 months gap, that is February and March 2018. Then such capital gains till date will be considered as grandfathered. We'll be looking into what is this concept of grandfathering when we are solving problem. And thus it will be exempt under section 1038 if STT is paid on such transfer. So if it's a long-term capital gain and if it was acquired before 31st January 18 and sold before 1st of April 18, because the new laws came into place from for the previous year 18-19. So if it is sold before 1st April 18, then long-term capital gain on equity shares or equity-oriented mutual funds is exempt from tax under section 10 subsection 38, provided STT has been paid. Now, tax on long-term capital gain on transfer of equity shares in a company or units of an equity-oriented mutual fund, that is covered under section 112A now. In budget 2018, that is applicable for the previous year 18-19, section 1038 has been withdrawn and instead section 112A has been introduced to tax long-term capital gain on sale of equity shares, on units of equity-oriented mutual funds or units of business trust, that is real estate, REIT, real estate investment trust and infrastructure investment trust. Now, what is the rule? What is section 112A specify? It simply says long-term capital gain arising from the sale of equity shares, equity-oriented mutual funds or real estate investment trust or investment or infrastructure oriented trusts. If it is sold in a recognized stock exchange and security transaction tax has been paid and which were acquired on or after 1st of February 18, that is after 31st January 18, acquired on or after 1st February 18 shall be taxed at a concessional rate of 10% in excess of rupees 1 lakh where the long-term capital gain shall be calculated without indexation. Suppose we have equity shares purchased, let's say on 10th of February 2018. It was purchased, let's say, for 35 lakhs. And the equity share value has gone up. Now, in the year 1920, I decide to sell those shares at around 4.5 lakh rupees. So it was acquired at 50,000 rupees. Now the sale consideration is 4,50,000. So 4,50,000 minus the cost of acquisition. That would be 4 lakh rupees. That would be long-term capital gain because it is more than 12 months. Long-term capital gain. As far as tax is concerned, out of 4 lakh, 1 lakh rupees is exempt. And on the remaining 3 lakh rupees, a tax rate at 10% will be calculated, which would work out to 30,000 as mentioned in the example. And this is calculated without indexation. Tax on long-term capital gain arising from any other asset other than shares is 20%. If the long-term capital gain is computed after indexing, and 10% if the long-term capital gain is computed without indexing. So as mentioned just earlier, it is 10% right here without indexation. This is more so on shares. 10% in excess of rupees 1 lakh, where the gain is more than 1 lakh. On that excess amount beyond 1 lakh, 10% is taxable. Whereas in case of all other assets, long-term capital gain is taxed at 20%. That is after indexation. So that's all under section 111A, 112 and 112A section. Thank you.